I'm going to turn it over perhaps to you, Ilya. We're at the half-hour mark. Again, I'm excited. What we're here to do is to make money and help the world. And some of these managers can do both, and probably all of them. And some of the LPs are very well represented. So over to you, and thank you, Ilya.
Thank you, Mark. Welcome everyone to this event. It's focused on outperformance. That is the theme of this conference. So in the first part, we start with the opening panel of some great GPs that we curated, all of whom overqualified, in fact, to appear on this panel. And most of them, as I just mentioned, could give private equity funds a run for their money. As we just discussed, small, when it comes to private credit, small is beautiful. Some niche strategies can definitely outperform. Execution is also very important. And so during this panel, we'll explore different strategies within the world of direct lending. After that, there will be an LP panel, which I'm going to moderate. It will focus on co-investing. Co-investing is yet another way for a fund investor to outperform if someone can make good use of the co-investment opportunities available, of course. There we'll have 3 groups of investors well represented. There will be institutions, that is Greg Schuler, Fred Greer, Chris Brown. There will be family offices, Vatsala, Aruna, Shalam, and myself, and the fund-to-fund perspective from Tim O'Hara from Europe. And after that, in the best traditions of deep dive at 361 firm, there is going to be a series of workshops by the same managers that we're going to meet now in the opening panel. And there we'll hear some war stories, and we'll be able to also get a good perspective on how some problems are solved.
Great. Should we go right ahead and turn it over to Sam?
Perfect. Hello, everyone. Welcome to Private Credit Deep Dive Conference. My name is Sam Monfard. I'm a member of the Research Insights team at Preqin, and I will be moderating the GP panel today. We have a great panel. I'm delighted to welcome a very distinguished group. Before we dive into the panel discussion, we'll take a few moments for each of the panelists to briefly introduce themselves and tell us a little bit about their background in the industry. Why don't we start with you, Andreas?
Thank you, Sam, and thanks, Mark, for having me here. I'm Andreas Bodemeyer. I'm a partner and co-founder of Chicago Atlantic, and we have focused on one of the niches in private credit, which is the U.S. cannabis space. We see an opportunity for outperformance, both on economic side, but also on the structure side. And I think we talk about outperformance a lot in events like this. Something to consider is also the structure, the leverage ratios, the covenants, etc. So we're a firm with about 300 million of total credit, 18 people based in Chicago, and look forward to participating in the panel.
Perfect. Thank you. Brett.
Hi, good morning or afternoon. Brett Hickey, founder and CEO of Starman Capital. We manage $2 billion. We're an 11-year-old firm focused exclusively on the US lower middle market. We have 2 complementary strategies. One we call value-added lending, where we work in a consultative manner with founder and family-owned businesses, helping them finance acquisitions and other growth, and then help them position to sell with a strategy that we look to continue to generate alpha for our clients with. The second is secondary purchasing of lower middle market LP positions. And within both strategies, the aging demographics are quite constructive for us.
Perfect. Thanks. Richard?
Sure. So Richard Nespola, I help run a family holding company called Working Lab Capital that represents my family office and my partner Michael's family office. I've been running that kind of family holding company now for the past 7 years, running a bunch of opportunistic investment strategies up and down the capital structure. As it relates to private credit, several years ago, we launched a specialty lending company called Better For You, or BFY Capital, that is a specialty lender to health and wellness brands. We found that there's a significant dislocation in the need for effectively venture debt or structured credit to support the scale operations of those businesses, while also creating an impact orientation towards supporting health and wellness on a greater societal basis, as well as kind of the founders that are propping up those companies.
Thanks, Richard. And Brian.
Sure. Good morning. Thanks for having me. My name is Brian Walter. I'm a partner at RealFi Partners. We are a real estate bridge lending fund. We do it in a private REIT structure. We also have some sidecars in the strategy as well that we offer out to our LPs and sometimes individually. Real estate bridge lending. I used to run a family office, which is where I came across the product. I was in middle market lending before that. Helped my principal sell the asset manager to Oaktree Capital, and went to run his family office after that wealth event for him, and came across real estate bridge lending. I find it to be a very low vol, uncorrelated asset class, and when you focus on sort of the under 10 million loan size, you still can get outsized returns as the competition for deals is a lot less. We are looking to grow the private REIT and take advantage of the opportunity that we see in front of us as the banks post-crisis, post-Dodd-Frank, and now post-COVID have really left the lending space in many aspects of the lending space, leaving a great opportunity for private lenders to come into the space.
Thanks, Brian. Let's get right into it. Inflation. Headline and core CPIs went up faster than expected in May, up 0.6% and 0.7% respectively. Headline inflation increased from 4.2% to 5% in May year over year, the fastest since 2008. And core CPI inflation accelerated from 3% to 3.8% year over year, the highest since 1992. The Federal Reserve now sees at least 2 interest rate hikes in 2023, after saying in March that they have no plans to increase the rates until at least 2024. 7 of the 18 members now see the Fed possibly increasing the rates as early as 2022 next year. So the question to the panel is, if rates start going up, more specifically high yield, how is that going to impact industry's AUM? And most importantly, future performance from your point of view? Brett, why don't we start with you?
Sure, it's a great question, and both, I think, an opportunity and a challenge for many. So first off, let me talk about how rising rates in particular could negatively impact the macro economy. I think there are a lot of larger businesses that have high leverage ratios, and if you do some basic math, take a company that's 6 times levered in the middle market, somewhat of an average, and never mind EBIT adjustments as far as how actually levered it is. Let's assume their average interest rate is 6%. If rates go up by 1%, the percentage difference in the expense burden that those middle market companies have can be tremendous, right? 30, 40, 50% more expense burden than what they had before. So as you see a lot of companies today that are barely covering their interest rates, I think you see tremendous risk in the middle and large market that we believe at Star Mountain is really unaccounted for, and how much risk there is in high yield and middle market in general. That if that does happen, then that of course has a flow through into the whole economy, because there's enough leverage out there across enough companies that could have a macro impact. As that feeds down into the lower middle market, generally speaking, capital inflows have not pounded the lower middle market as they have the larger markets. And as such, you haven't seen in general the same type of leverage ratio increases. That's one. And then 2, the average interest rates are generally higher. So for example, again, do the math, take a company that on average is paying an 8% interest rate, and if it goes from 8 to 9, and it's only levered 3 times, that delta of increased interest expense burden is radically lower than a larger company. On average, when we did the math, we think it's about an 80% differential between your average middle market and lower middle market company. So I think that makes the lower middle market something that we believe is more compelling, but the macro risks can still impact the whole economy, as you talked about 2008. And then a couple things to hedge against that, if you will, a little bit, or protect against it. I think most people, even in the lower middle market, do floating rates. So I think that's helpful. And then for those of us that have warrants and other equity upside, hypothetically, that should become worth more if we do hit an inflationary environment.
Perfect. Andreas, what's your point of view?
I would agree with what Brett said, and I think in terms of strategies out there, I think what will be somewhat protected is those with exactly floating rates. That's something that we focus on at Chicago Atlantic, and as well short duration. So real estate bridge lending, for example, doing one-year bridge loans, that's something that can adjust very quickly to not only changes in the inflationary environment, changes in interest rates, but also changes in overall macro. And I think, you know, there are different predictions on what the Federal Reserve will do. There are different opinions on the Fed board itself. And I think you see that in the market, you know, on the longer end, going from 7 to 5 year terms, going from 5 to 3 year terms. So that I think will play a role in the future as well.
Perfect. Brian.
Yeah, for our product, we make real estate bridge loans. We're backed by real estate, which inflation is usually pretty good for. So our asset values against what we're lending against tend to be going up. Of course, rates may be increasing as well, which may reduce the demand for real estate. But I think in general, in a fairly average inflation environment, the inflation aspect will outweigh the decrease in demand for real estate assets due to higher interest rates, and it's a net positive. And as Andreas pointed out, most of our loans are 12 months, maybe a 6-month extension option. So an example of that would be going into COVID, the average coupon in our portfolio was 10.60. The average coupon in our portfolio 12 months later is 11.80. And that's not due to rates, that's due to banks pulling back and the market backing up a little bit, where we were able to go from 10.5% with 2 points of origination, kind of average deal, to now 12% with 2 points of origination as our average sort of deal. So, you can see the benefits of the short duration on average coupon in our portfolio.
Richard.
Yeah, it's interesting. I'll echo a lot of what what was said before from Brett related to the underlying assets being over levered and kind of an increase in debt service kind of being a detriment to long-term performance. I think the thing that hasn't been mentioned so far, and I agree on the short duration plays in real estate, etc., is really actually the fund construction itself. I mean, if you think about a lot of the ways that lenders in the private credit space have worked, they've worked under the assumption that there is a large base of a warehouse line. There's a warehouse lender that gives them additional leverage to generate very juicy returns back to LPs. Well, those warehouse lenders are going to increase their spread requirements as well. And if those borrowing costs can't be passed on to the borrowers themselves, you're going to start to have economic compression at the underlying asset manager, right? So contribution margin flowing through to the actual I would say that the GP that you're investing in also has to be part of the consideration set too, right? In terms of their own unit economics per loan, et cetera. So I think there's a unique kind of play at work, depending upon, how the facilities are being run, how people are kind of constructing their overall economic profile. And I think the flip side of that is it also presents a unique opportunity set, right? So if you have a lower base of capital, I think going back to the AUM and kind of macro commentary, if you have a depository capital like a bank, right, and you're not dependent upon a warehouse line or private line facility, it creates a really unique arbitrage opportunity for those that are rate sensitive on the borrowing side to refinance out. You'd normally think that an environment that's going to be higher yielding would be beneficial for all. I actually think it exacerbates kind of the dislocation and kind of borrowing spreads between those that have depository capital and those that don't, right? For better quality assets to refinance out with a little bit more predictability, right? And people willing to lock in a longer term kind of interest rate hedge, right, than they would kind of being on a floating rate basis. And I think that's a way for people to win business, right, without sacrificing quality or kind of credit covenants, et cetera. So I actually think it's a really unique time to be in the space.
Very interesting points. Let's move on to the next hot topic, capital consolidation. Last year, according to Preqin's data, the 10 largest funds accounted for close to 40% of the capital raised in 2020, and which was up from 30% that we saw in 2019. If you look at outside of top 50, they only managed to raise close to 21% of the total capital raised. And we have been noticing this trend really since 2017. So the question to the panel is, how is this going to impact the future of the industry in terms of performance and covenants? Brian, why don't we start with you?
Sure. This is actually one of my favorite stats because it's just increasing the opportunity set for us. You know, the space I was in prior to running the family office for my principal was the BDC space. We sold our BDCs to Oaktree. You know, when I first got into the BDC space back in 2015, if you could do a $75 million deal on your own, you were in the top tier. Okay, you now fast forward 6 years, you look at KKR, who just merged their BDCs and they have $15 billion in capital. A 1% position size for them is $150 million. It's not worth their time to work on deals that are smaller. So what's that doing for players like us? And the same is going on in most private lending industries or sectors. It's just increasing the opportunity set where the bigger players, it's just not worth their time to play in the $5 million, $10 million real estate bridge lending space. They want to look at deals that are 20, 30, 40 million to leverage their infrastructure. And that means less competition in the sub $10 million sector where we've really focused, where we can get 12% coupons on the deals that we do because there are no institutional players that are willing to play in that space. So if we can bring institutional knowledge and know-how from the background I come from to this sub $10 million space, it allows for 200 to 300 basis points of incremental yield and coupon while still providing the safeguards that investors need in terms of a company that's audited, third-party administered, and has institutional processes in place.
Interesting. Brett, what is your take?
Yeah, just to go deeper in agreement with what Brian said, keeping it really simple, right? You can't fight the laws of gravity, supply demand. Massive capital inflows into the middle and large markets. You just point out, right, the percentage of funds that are billion plus. As Brian mentioned, a lot of the other funds that are huge. And a lot of our investors, for example, say, well, why is that? It's in a skeptical manner, as investors should be. And we say, well, one of the reasons is that aging demographics. A lot of the asset managers are interested in selling their businesses. What people may not know is that your management fee EBITDA multiple is generally about 300% higher than your carried interest multiple. So the motivation to drive AUM, drive asset management fees to monetize your business is actually very straightforward. And we all know of the Dyal Capitals and similar folks like that of the world. There are a lot of buyers out there for asset management firms that way. And so that's driving that. The second major force that's not going to be slowing down is high yield is not so high, right? So when you think about a lot of big institutions saying, well, why not get paid a little bit of premium for a bit of illiquidity in private markets versus high yield? And when you shift out of high yield today is 4% or sub 4%. Covenants, basically none. Due diligence process, light at best, right? Governance abilities, light. Leverage, high. EBITDA adjustments, high. And so to shift out of that world, if that's the world you're used to, you're happy continuing to get something that's the same, but with a little bit of a higher, yield premium in private credit. And that's why I think you see a lot of private credit funds now being raised. Sam, you guys would have the data on this, but you see a lot of private credit funds with a carry return hurdle of only around 5%, which actually makes sense because that's maybe 25% higher than high yield. But a lot of people, as you pointed out earlier, and what they're looking to achieve for returns are a bit different than that. So anyways, we would view that the inflows of capital will continue into the places that are easy for capital to flow into in a scalable way. And that just makes the valuation arbitrage between the lower middle market and the middle and larger, more efficient markets that much higher, as Brian pointed out, and therefore, more attractive for those that have the origination capabilities and resources to cobble together and help grow smaller deals.
Interesting. Richard, what is your take?
Yeah, I think the commentary has been spot on, but I would like to add a couple of different points. I think, one, I said this on an earlier call, I think a lot of investors, especially institutional investors, it's a giant averaging machine, right? Everyone has a tendency to regress to the mean, and they're not finding kind of the outlier alpha at the fringes, right? So, and this goes into the next question a little bit more on niche strategies, but I think for those that have a unique return profile or really more structured kind of underwriting and are looking with a niche industry with conviction, there is an opportunity to just kind of outperform without the level of competition and capital inflows compressing, kind of overall returns and yield in terms and conditions, especially as it relates to covenants, right? So, and what we found historically is, the larger guys who have followed in the footsteps of, the Ares and the Golubs and everyone else, right, are basically, to Brett's point, syndicating and, looking for, incremental gains as opposed to step function gains, right? Whereas I think, niche managers who have a point of view, who want to kind of find those unique asset classes where they can, basically have asymmetric information and leverage it to their advantage to create alpha, right, for better returns for their investors and as a GP through a more aligned interest, a much better outcome, right? So I think that's starting to continue to play out where, the safer kind of institutional bets are very happy with low single digit returns, and the spread differential is, really incremental between high yield and private credit with maybe a bit more kind of certainty around the underwriting. But then again, we've seen other funds kind of go through cycles where, because of their kind of misaligned incentives, they're trying to push capital out the door just like everyone else, right? So they're getting a little bit more lax in their investment committees and their underwriting, to say, well, this is probably 90% of the way there. A couple of years ago, we'd make sure it was 100%, right? But we're comfortable enough with a 90% confidence interval to get the money out the door, right? Because we're trying to $1 billion fund, right? So I think that aspect and those incentives are driving a lot of that behavior. And I'd also say too that I think to Brett's earliest point, there are a lot of bad companies that were over-levered and funded with cheap credit. And you're going to start to see that play out where, the strategy of convincing borrowers that, the cost of capital and weighted average cost of capital, debt capital is far cheaper than equity until the covenants get tripped, right? You have to accelerate and do a workout. It goes in the NPL status. So it's an interesting kind of dynamic between, people kind of ratcheting back the covenants in order to get deals done because that's what borrowers wanted, and kind of pushing off some good credit discipline and monitoring discipline versus, coming back to a sense of reality of just making good investments. And I think that's going to start to play out.
Perfect. Andreas, what's your take?
I fully agree with previous comments, and I think I'll add two thoughts. What we see is now specialization going up the AUM range where, years ago, $1 billion credit fund would be pretty broad across industries. Now you see more and more funds that focus on maybe 3 to 5 industries to build some sort of a competitive edge and specialization, which can lead to some outperformance. I think the second trend that we see is that because overall the loan demand hasn't really shifted. It's not like suddenly all companies became those that want a $150 million credit facility. Is that you see those larger firms do JVs with smaller lenders like us that have certain expertise in industries and can capture some of the outperformance by way of partnering with a smaller expert in their field.
Perfect. Yeah, we briefly talked about innovative strategies when Richard was talking about capital consolidation. So let's continue the conversation in that direction. LPs are focusing more on diversification and adding new, private credit strategies to their portfolios, specialty finance strategies from, private ABS warehouse facilities, asset-backed lending to royalties, secondaries. What do you see in the market, and could these strategies enhance performance in portfolios and add value? Richard, why don't we start with you?
Yeah, so I mean, we actually started BFY through this pain point exactly, right? Which was a sense of all the kind of commentary I had before on a lack of kind of rigid kind of credit underwriting discipline and pricing on a risk-adjusted basis. One, two, kind of playing outside of the realm of being a race to zero, right? Where all you can do is compete on terms and price and speed, as opposed to actually making sound investments. And then three, being in a situation where having a mindset or an opportunity or point of view on where to allocate capital. We're not kind of a typical fund manager, right? We're really kind of building a finance business in a very specific industry that has this dislocation where there's an over reliance on asset-backed lending lines of credit and ABLs and factoring, where venture debt or structured credit is just a new kind of thing, right? Which, if you take a look at levels of innovation in finance across a lot of other industries, it's just a laggard, right? Even though it's a $55 billion plus industry in kind of natural and organic food, beverage, beauty, and pet, no one's really kind of attacked that space, and predominantly because it's not easy, right? So it's really more of a venture private equity style underwrite, as opposed to just putting in a credit box and seeing where it gets spit out in terms of leverage ratios and fixed, covered charges, et cetera. So, I think the specialty play is important from an asset diversification standpoint, especially, we built it for our family, right? And on top of it too, creating a point of view that, allows us to have an impact orientation without sacrificing, yield and total return, right, is another added benefit. So trying to do things in a way that are interesting should, I think, be a core area. Again, we're not kind of running to the middle with everybody, and I think niche strategies that we've seen play out very well are in markets or certain areas that people aren't as familiar with. And I think the other thing too, outside of just industry, is kind of this geo arbitrage that's taking place, where you can look at a mismatch in kind of specialty lenders or folks throughout LATAM and other areas. You have a resurgence of neobanks. You got a resurgence of fintech players that are creating lending opportunities because the banking system's just so horrible, right? And they're taking advantage of that and making great returns and yield spreads across real estate and private lending, and even kind of, afterpay, buy now, pay later models that just haven't permeated in that kind of region of the world. So you start to see these kind of, replicated strategies that are niche within their own domain, where here in the US, they may be very ubiquitous and commonplace. In other regions of the world, there's massive opportunities for kind of, spread and arbitrage. So, I think generally speaking, niche plays are in private credit, are a mindset more than anything else. And you can be of the mindset to follow everyone else, right? Or kind of go out and kind of hang your own shingle, or have conviction behind others that have a point of view.
Andreas, what's your take?
I would agree with that. And I think you see more comfort among LPs allocating to niche strategies. I mean, historically, with the shift into private assets in general, there was great comfort with real estate, and also with industry-focused private equity strategies, because if you're an expert in a certain industry, you might as well be on the equity side. And credit was more viewed as alpha delivering the spread to private markets. I think as credit has become more competitive, LPs also are more comfortable investing in experts in certain industries. And we've certainly seen a niche that is somewhat unique with cannabis, where there's an institutional restriction from a big portion of the private credit capital base. So with the institutional restriction and the complexity of our industries, I think something you see that in whether it's royalties or small ABL that you know can help with outperformance and limit competition.
Perfect. Brian, what do you think?
Yeah, I mean, look, our view here is origination and structuring have become the new value add, and on Wall Street, if you will, right? Analysis and information has become so cheap that it's become somewhat ubiquitous, and those that can, but origination is hard, and you need to have specialty focus, and you need to have relationships, and these things matter. A third of our portfolio is repeat borrowers. The acquisition costs of new loans is something that's difficult to build, and something that needs to be kept an eye on. And there are certain parts of our markets that people have tried to technologize, for lack of a better word. We've had some aggregators come into the real estate bridge lending world, most often in the fix and flip vertical of real estate bridge lending, but they're generally relying upon third-party capital, and a lot of that got disrupted during COVID. It's one of the value adds of actually having a fund. We actually picked up quite a few relationships throughout the crisis for people who had done deals, done construction loans with builders during the crisis, and then their third-party capital, or prior to the crisis, and their third-party capital pulled, and now they didn't have money to fund their commitments. And we were able to step in under very attractive terms, and now those relationships have, now we're one of those relationships we've done 10 follow-on deals with. So, and then I think some people had mentioned the banks. The banks, for all intents and purposes, post 09 have become utilities. And if you think about the maturation in our world of, acquisition loans, land loans, construction loans, the banks really only want to finance stabilized properties. You have to be a very good client of a bank to get a construction loan. And it just leaves a massive world for us to dig into for origination. And then lastly, I'll say, as I think Andreas commented on, is speed. The banks just cannot compete on speed. It takes 3-4 months to close a deal. If anyone's tried to refinance a mortgage lately, it's no quick task. We can close a deal in 2 weeks. And we have builders, experienced builders, that are willing to pay 300-400 basis points more in rate, because we can go out on a Saturday, do a rec on their construction project, and they have their money on Wednesday. It would take 14 days for a bank to get them their money. And when you do the math on their ROEs over the course of a year, it's significant for them to get their money, because it's all about velocity of money for them.
Brad, what's your take?
Yeah, thanks, Sam. Two things. One, following up on origination, I think that's critical. It's a simple way I like to think about it. It's quick and easy to access. A lot of people are going to be looking at it. And so to that end, what we at least find at Star Mountain is within the more non-sponsored lower middle market, so founder and family owned, it all sounds great, but to Brian's point, how do you find them? So for us, with 80 people exclusively focused on the US and Canadian lower middle markets, we have at least one person local in over 20 cities across the country, and have, I think, the largest, if not one of the largest infrastructures in the country that's exclusively focused on this end of the market. The other thing at this end of the market that you don't get, for those of us that worked at bulge bracket investment banks, which many of my partners ran divisions of Goldman, Credit Suisse, and so forth, you can't get those services at this end of the market. So there are business owners that are willing to pay for services bundled with capital, in effect, And I think that's a great way when you think about how do you generate alpha, how do you get paid for something that's not risk? Well, services is a good thing to generate risk. But then that gets into, well, you've got to pay for those services and fees, right? So GPs hate to talk about fees, of course, but the reality is it's an important conversation. And so what we've done at Star Mountain is really taken a data-driven approach and provided a lot of transparency to investors around that, looking at what do you generate as far as returns per unit of risk measured in the form of leverage? What do you generate in net returns per unit of fees, right? As far as efficiency of capital, what's your alpha beta Sharpe ratio? How do you benchmark against, Preqin, most importantly, of course? And what is your statistical persistence of returns? What does your return distribution look like? Are you getting some nice right tail skew from your warrants and other upside? And how is that relative to any potential losses that you may or may not have had? And then how does that look as you head into the future? What does your current portfolio look like as a leading indicator in the future relative to historical results? And we found that data-driven approach, if you have enough data and information, that investors really eat it up, and that's been quite constructive.
Sure. Perfect. Let's move on to expectations. We have a few minutes left, so hopefully we get to cover two questions, but one for sure. So in terms of expectations, direct lending, looking at the historical performance, the median IRR has been around 8.6% for vintages of 2008 to 2018, with a standard deviation of 5.2, mezz around 9.6%, median net IRR, special situations 9%, distressed only 8.8%. In our last survey, when we talked to investors in terms of what annualized absolute returns they target for private credit, 52% said somewhere between 6 and 9, and 71% said between 6 and 11. Brett, as you mentioned, the ICE high yield index is somewhere around 4%. So looking into the future, what sort of return expectation, what sort of returns can investors expect from private credit in your area, and what has been the key driver of your outperformance? And obviously, I want to emphasize that whatever we say here is not a guarantee of past performance. Has nothing to do with future performance. Let's
my
start.
Compliance officer would have been happy to hear you say that, Sam. Thank you.
Yeah,
I unfortunately can't really get into returns or anything. If anybody's interested in learning about our products or anything, we're happy to follow up with us and probably talk. So I'll talk just generally about the markets. In lower middle market, non-sponsored lending in particular, where it's harder to find the investment opportunities, more labor intensive to underwrite them and to manage them the right way, at least in our opinion, also more labor intensive to help companies deal with both threats and opportunities effectively as their strategic capital partner. So in that, I think in general, people are looking to generate 10 or better % cash yield to maturity, and then potentially get additional alignment and equity upside to help businesses grow beyond that. And I think that you've got the data as far as middle and large markets, as far as where that more generally is from your historical returns. And we would presume the future, as everybody's talked about here with the capital inflows, and relative to where the high yield market is, it's natural that you're going to have a lot more capital inflows if you can generate a 7 or 8% net return, which is double high yield. Why wouldn't you have more capital inflows? So presumably you'll continue to see that, and presumably as supply demand continues to push, you'll see the more efficient market returns come down. And I think for those of us in niche strategies, the relative value of niche strategies and the lower middle market in general should presumably continue to be even better.
Perfect. Andreas, what's your take?
I think the compression in terms of yields that we've seen over the last years will continue, and also the structural compression in terms of underwriting covenant, just because competition is high. For us, also being in a niche, we've seen in the cannabis space, if you look at the top decile of operators that are Canadian publicly traded companies, there's institutional interest, money has flown in, and you're in the high single, low double digits versus private middle market, you're in the mid to high teens as a cost of capital in the industry overall. I think there's no strategy or niche that can sustain above market returns for a credit manager. I think you have to look for additional opportunities, and for LPs, for investors, I think picking the right managers, picking the right niches, and being somewhat nimble and reevaluating allocations between managers becomes more and more important, because the velocity of capital is, I think, faster compared to years ago, where you allocated to one credit manager, and that was an allocation through fund 2, 3, 4, 5, 6, etc.
Sure. Richard, what is your take?
Yeah, it's interesting. So, I mean, I think we don't spend a lot of time thinking about the macro trend, right? We're kind of focused on, extracting as much value as possible through this dislocation of risk-adjusted returns and price as an alternative or complement to equity, right? So this goes back to the point of, having a point of view and really kind of doing I think the legwork of understanding where these dislocations exist. So, from our standpoint, without getting into too many specifics, I mean, we are in line, I would say, anywhere from 70% to 105% of a standard historical private equity type return within kind of this consumables asset class, right? So over a long tail, that's 15 years been averaged about call it 22% on a gross basis. So when you take a look at that through senior secured first lien structured notes, right, through kind of the way that we've invested plus warrants, we're about 40 to 50% of the upside through the warrant, and then the other piece is really through yield construction and the way that we kind of do our work. I think to the point that was made earlier, there really is a benefit to understanding the intimate details of structuring, right, and really kind of leveraging that kind of insight to your advantage relative to what alternatives look like. So when you have headroom and you don't have a lot of other people playing in your space, and you can do a good job of educating the borrower as to what the trade-off costs would be between all these other type of financing solutions out there, between equity or ABS or effectively doing factoring, etc., you come up with a very unique kind of point of view that they gravitate towards, and then you can have kind of repeatable, kind of virtuous cycle of generating really good returns, right? And I think that can be repeated in a whole bunch of other niche areas. So I think the yield compression piece is real, right? Because of this competition over, limited assets and everyone going for the same stuff. And, inherently a lot of people are lazy. I think, capital inflows and the ability to underwrite and put capital out has, made people kind of rest on their laurels a little bit, and they're not willing to put in the work to find unique places to put their capital. So and by the way, that's on the GP side as well as the LP side. Right? They're happy, they're content with, having what the market dictates for them, which is what an average return should look like. So yeah, this looks fine. I don't have to get a 1 or 2 standard deviations of improved performance. Like I'm with everyone else. And as long as I'm not screwing up, I'm safe. Right. And that's where we just, our mentality is a little bit different, where, for what we're doing as a family, we want to lean into things where we have a point of view and conviction. And then, in other asset classes and other areas, yeah, we're okay with those types of median returns. But, for what we're doing for specialty credit, we have a point of view.
Ryan, what do you think?
Sure. I mean, for our asset class, we certainly target 10+% net returns. I mentioned earlier that our average coupon in our portfolio is 11.8 right now. Doing, kind of simple math on how things would look, and at least, pointing out the drivers and levers that could outperform and underperform these sort of numbers. If you have an 11% average coupon, we also share origination fees, exit fees, and extension fees 50-50 between the GP and the LP. So if our average origination fee is 2 points, that's another 1% to the LP. So now you're at 12. we use a little bit of leverage, maybe 0.2 times, 0.25 times, which adds, incremental return to that. And then, our fee structure is sort of 1 in 20 above a 7, gets you kind of into that mid tens structure. Now, what could drive that one way or the other? Average coupon, for sure.
Sorry, I have FINRA on my shoulder. We have to not talk too much about the specifics on the fees. Sorry, yeah.
Okay. But what drives our returns? There's potential for default interest is certainly, we have generally 24% default interest into our into all our loan agreements. In the states that we operate, most allow up to 24%. So, sometimes a couple times a year, you'll get default interest. So in our product, oftentimes, more often than not, when something goes into default, it's not necessarily write-offs and losses. It's actually upside and opportunity. The average loan to value in our portfolio is 50%. If you think about an LTV of anywhere in the 50 to 60 range, we accrete, if we had a 12% note accreting at note rate would be a 7% accretion per year. So we can be in default for years, 2 to 3 years before we can actually go through the foreclosure process and not be impaired, obviously holding asset values constant during that situation. So, we oftentimes are, now in reality, what ends up happening in our product is you end up settling somewhere in the middle, right? We accrete at 24% and they come back to us because they have equity in the project and they say, look, can you settle at 18? And most things end up settling in the 16 to 18% world on defaults. So, these are the things that can drive, returns one way or the other, average coupon, origination point, compression, et cetera.
Just mindful of the time. Sorry.
Thanks for everyone. Mark, I don't know if we allocate maybe 2 or 3 minutes to if we can get a question from the audience. Do we have time for that, or do we want to?
No, it would be blasphemy if we didn't allow interaction. So maybe a question.
Yeah, if anybody has a question, please post your question right now to the chat, and we'll pass your question to the panel.
Could be somebody.
Lots of softballs.
Right. Could be even someone from the or the LP panel. Crickets. Not like us.
No, I think they followed your instructions, Mark, and John just posted something to the chat to everyone. So
I have a general question from the managers. How are you seeing the competitive landscape in private credit? Obviously, there's been a lot of money flowing into the space. Is that a challenge, and how do you kind of navigate that?
Richard, you want to?
Yeah, I mean, it hasn't affected us, quite frankly, because we're just in an industry where there aren't as many kind of structured credit players, which allows us to kind of maintain, kind of rate and return profiles that, meet our target returns. I think generally speaking, also as a family office allocator, looking at the space as well, again, the niche players who were able to, create asymmetric kind of returns are better served. I think the larger allocators, are getting compressed, right? They have to compete on terms and price and speed, which leads to a lack of credit discipline. So, I think that hasn't changed over the past several years, right? One. And then I think the other side is, over a long enough time horizon, we won't be unique in our space, right? So, you find a niche, it's a niche for only so long, right? People catch on to what you're doing. They see the type of returns and spread yields you're able to generate. They want some of that action too. So it's important to find multi-winner markets, right? Those that are large enough to handle, multiple lenders going after similar types of deals. And I think that's incredibly important.
Anybody else wants to
Yeah, I mean, for us, it's, as I said, I think the larger players keep going up. Their average loan size that they will look like, or their minimum loan size that they will look at in our industry keeps going higher and higher as they raise more money. So, for us, we tend to focus in the 10 million and under loan size world. We're not running into people like Fortress or any other players in this space because it's just too small a loan size for them to care about. What that ends up leaving us with are players, small niche players like us, or people that rely on third-party financing, as I mentioned earlier. And we've done, I think, we've tried to educate people on who they're borrowing from, and making sure that they're not relying on third-party financing behind their loan, because that can create problems. And COVID was an ideal situation or example to use to people that, you need to make sure that there's a fund and capital behind these loans that people can stand up to and continue to fund your loan. And that's been a great successful, I think, story for us to tell.
Hi, it's John Pagley. I just thought I'd ask this publicly apart from the chat. We have seen with varying frequency the launch of private BDCs, and I did learn of Star Mountain. Yes.
I love you like a brother, but why don't you hit that in the breakout with Brett so that we stay on time?
Sure.
I assume it's a question to Brett.
And thank you.
I just want to say thank you to you, Sam, for kicking this off, the framework, and love working with Preqin. Ilya, can I turn it over to you for the LP panel?
Hi again, everyone. We've got a great panel with both institutional, family office, and fund of funds side represented. So why don't we start with panelists introducing themselves? We'll start with Greg Schuler.
Yeah, hi, it's Greg Schuler. I've seen some of you on these events before. Tomorrow's actually my last day at Pitt, but I've started up an entity called Waterton Capital Management. But most of my experience is on the family office, endowment, hospital system side as a CIO.
Great. Next on deck is Fred Greer.
Hi, thank you for having me. I oversee the investment portfolio at Carilion Clinic. We have assets of $3 billion, split approximately half in a defined benefit pension plan and half in a long-term investment portfolio. And my background, I've been at Carilion Clinic about 6 years. Prior to that, I worked for a defense contractor on the pension fund and a church pension plan, and then had experience working in investment management firms in New York for about 10 years. We are pretty active in private credit. We started moving our portfolio to in-house management about 5 years ago. And kind of my question in the last panel discussion was about the state of kind of capital flows in private credit. And we have, similar to the responses, we've kind of navigated the market by identifying niche strategies, such as a mining lending strategy based in Canada. We have a venture lender in California. We have an asset-backed lender. And we have one middle market private credit strategy that focuses on the lower end, the sweet spot of about 25 to 30 million EBITDA. And in our portfolio, we do periodic direct co-investments as well.
Thanks, Fred. Chris Brown, I think you've been an active member of the network.
Hi there. Yeah, thanks for having me. So I'm with Allstate Investments in our, what we call our opportunistic group. I'm in Chicago. Our group sits between private equity and traditional debt. So I kind of call us, quote, tweener capital. We are both an LP in other people's funds, as well as keen to be a co-investor and do some deals direct. In my background, before we started this group, again, the opportunistic group at Allstate, which has about $1 billion of capital the opportunistic group, Allstate in general has about 60 billion, has all been in credit, starting as a lender and then doing distressed debt. And a lot of my colleagues in my group have distressed debt backgrounds as well. So we consider ourselves kind of roll up our sleeves credit folks.
Great. Vatsala, would you please introduce yourself?
Sure. Hi, everyone. I'm happy to be here. So I'm from investment team from a single family office based in Malaysia. So the group invests in telecommunications, broadcasting, and media, energy support services, and real estate companies. We play an active role in operating these companies via board participation and owning majority stakes in these companies. So along with this, the group also manages alternative assets. We're managing about north of $800 million, investing across various strategies, ranging from private equity, buyout, growth, and venture capital, hedge funds, real estate funds, and fixed income. And we have a flexible strategy, agnostic in terms of our sector and also geography. And typically we invest USD $5 million to $50 million per vehicle. And we also look for investing with the GP on co-investment opportunities. Yep, thank you.
Last but not least, Timo Haro, your name is well known to the private debt community in Europe, but perhaps not so in the States.
Yeah, thanks, Ilya. Thanks for having me here. So I'm Timo, founder and partner of Certer Capital. We are a European fund-of-fund operation, around 1 billion of funds under management, investing in European private equity and private credit. It was interesting to follow the GP panel as the sort of supply of capital theme was brought up quite strongly. That is clearly what defines our investment approach mostly. And it has led basically to 3 pillars of investing, i.e. doing typically smaller or investing in smaller transactions and niche strategies, investing a lot with emerging managers, and doing a lot of co-investments. So we try to allocate around half of our capital into direct investments and mainly through co-investments.
Thank you. So our first question is the most general one, but perhaps rather important. What is your motivation for making co-investments? Is it outperformance in line with this conference topic, or is it perhaps just getting the additional exposure as desired, be it in terms of seniority, liquidity, particular type of borrower? And when you did make those co-investments, did you observe meaningful outperformance? We'll start again with Greg.
Yeah, I would say the motivation when I was at both BJC and Pitt was solely return driven, and we were always looking for partners where we felt that they weren't allocating negative transactions to us, or transactions that they were trying to lay off, but great transactions where they had surplus capacity. So for us, we were very focused on how do we get access to the deals that seemed to have the greatest upside opportunity. And while we were at BJC, we were blessed in that we had co-investment into a company called Vroom through Catterton, for example. That was up 6 times. Through a number of buyout managers, we got access to transactions that were up 3 times. And so for us, it was trying to better understand what's a manager's investment process, which was a great part of due diligence for their next fund, but also how do we get access to their best investments. And so we probably did less than, I would say, 35% of the deals we were shown. We tried to focus on the ones where we thought the asset was mispriced with the greatest amount of upside.
Thank you. Fred?
Yes, so we have a co-investment program that we have developed over the last 3 years. Up to 10% of our portfolio can be in direct investments, both on the credit side as well as equity side. We've done a couple credit deals over the last few years. for our hurdle on the credit side, we're looking for a net return of 10% or higher. On the equity side, 20% or higher. So naturally, we're more focused on the equity side, given the return dispersion between, a direct equity co-investment versus the underlying fund. We found the difference in kind of co-investment opportunities on the credit side tends to be tighter versus the primary fund. So with that in mind, on the credit side, we tend to focus on a couple different opportunities, usually a distressed situation where there's more of an equity upside, or a credit, for example, with the mining strategy we have with a Canadian firm. If there's warrants tied to mining production, that's attractive. And then the other part is liquidity. If it's a deal where the expected duration is within a year or so, that's very attractive. We tend to obviously like firms with lower loan to value, but we did a loan, a highly levered company that was prepping for a sale. So the duration of that, it was more of a bridge financing to get to the sale that was already in negotiation. So the entire deal was less than a year, and that was attractive. So for us, there needs to be some catalyst, whether it's a restructuring turnaround, a pending sale, a short duration horizon on the credit side. Right now, probably of our 7% in co-investments, we have about 5% in equity and 2% in credit.
Great. Chris Brown.
Pretty simple for us in terms of motivation for co-investing. It's to reduce fees. I mean, and I say that relative to particularly our private equity brethren. I mean, it's a big book, and you do the math on the fees that are being paid, and it's just a really big number. And then number two, we have a big, at Allstate Investments, we've got a big public side group that are doing directs, for high yield and investment grade, et cetera, et cetera. They don't pay any fees. So they look at us and they say, on the private side, they say, these fees are astronomical. And so a half dozen plus years ago, we started, really focusing on co-invest in order to reduce fees. And then, the other thing, obviously, to pick and choose, to pick, what exposures we want to, to increase.
Great. Vatsala?
Well, I think there's really three reasons why co-investment is important in our investment program. Number one is relationship. So for us, relationship with top quartile fund managers is very important. So anything we do to strengthen those relationships and know our fund manager better is a real big plus. And number two is to optimize return. So, when you commit to a fund, there is this blind pool risk. So, that's why co-investment deals, we get access to specific deals, and the exit horizon looks, when you're going to exit. So that is number two. And number three is really research, shoulder to shoulder with the sponsor to do deals. It's very attractive for us, as a family office, to be involved in the due diligence with the GP who has a specialized skills in certain sectors. Is where we can learn, and also we can make better decisions on the primary side in the future. So these are the three key reasons why we really like co-investments part of our program.
Great. And just to remind everyone about the second part of the question, has co-investments actually contributed to the outperformance? So it seems like that was your case, Vatsala.
Yeah.
Okay.
Well, not all of it, but yeah.
Okay, so you were able to actually measure and capture that delta.
Not all of it did well. There were some, which made not a very attractive return.
Thank you. Timo, what's your take?
Yeah, so maybe catching on what Salah's point on learning to know the managers and kind of learning more on what's going on. I think that is an important feature. So it's a part of due diligence when working with new managers in particular. We often do the first co-investment kind of pre-committing to the fund, or at least in parallel. So that's an important feature. Then perhaps more on the portfolio side, I would say, or return side, building the portfolio side, three targets: better control on deployment, so quicker deployment, steering more towards the types of deals we like more, better risk underwriting, and maybe answer there to your second question as well. So we have had lower loss rates, or actually no realized credit losses on the co-investment portfolio, whereas some on the underlying funds, and then higher return potential. So both through the funds, which the fees which Chris alluded to. So obviously having no or very low fees paid on co-investments improves a lot the returns, but also better selection. So the underwriting returns in our co-investments are slightly better than the average underwriting returns on the broader portfolio, and moreover we have outperformed the underwriting returns in the selection. So it serves on kind of all aspects of building the portfolio.
Great. So it seems like everyone on the panel has been doing co-investments for quite a long time now, and clearly co-investment appetite from LPs has increased quite a bit. So the question is, what changes have you noticed in the way that funds offer investments nowadays? This is also opportunity to talk about the technical side of things. So we can talk about promoted versus non-promoted, GPs setting up co-investments or top-ups themselves, differences between large GP syndication and the mid-market smaller GP syndication. So these are just examples of technical aspects, just as a guidance to you. We'll start again with Greg.
So we've seen a variety of different structures in co-investments, ranging from zero management fee to zero carry interest, to a small management fee and no carry interest, or vice versa. I would say on the equity side, some co-investment deals that are harder to access, you're paying both the management and carried interest, just maybe slightly discounted. On the fixed income side, I agree with Chris on the fee portion. It's probably more important for us in the fixed income side because the returns are generally going to be tighter than on the equity side. I think it also depends on the manager. If it's a small manager and the deal is proportionally bigger than the capacity of the fund, there's more opportunity for co-invest versus larger funds. I've also noticed, and I'm curious to hear people's views on this. A lot of, particularly the bigger firms, are marketing co-investment funds, which I'm not exactly clear how that's different than a normal fund. If you have a group of co-investments, how is that entirely different than a fund with a group of investments? So I think the term co-investment has been kind of used in different capacities. We view co-investments as single direct investments that typically are already in our portfolio. We want to upsize for either a return purpose or a fee reduction purpose, or both.
Great. Greg Schuler, I think we missed you on this one.
Yeah, sure. I mean, I think there's been two changes. I've been involved in co-investments for 10 years, and I think it's a much greater acceptance at the GP level that co-investments need to be offered. I think it's been a much more positive development that GPs believe they need to offer their LPs co-investments. So I think that's one. I think too, along the same lines, is that the GPs have become more astute in the way that they distribute their co-investments, and that they know when they've got a really differentiated opportunity that they can tack a fee onto it. So for the really great deals, when they know they've got something really strong, they're going to tack on a small incentive fee, whether it's 5% or 10%. And I've even seen instances where they've tacked on the incentive fee and then they've donated that to charity. So I think that's the second development, is that the GPs are astute enough to differentiate between average and really strong co-investments.
Thank you. Chris Brown.
Yes, so we've definitely seen changes over time. So two things I would highlight. Again, our private equity guys always think the co-investor should be free. On our side, with opportunistic and credit, we've never, most of the folks GPs that we work with, it hasn't been free, and so there's a tension there that we see, and we're keen to see that as that changes. In some cases, we've seen it go both ways. That on the opportunistic and credit side, the fees have gone up on co-invest, and in some cases they've gone down. But it's a dynamic we're watching, and I'd be keen to hear what others have seen. The other thing that I would say in terms of something I thought that was very interesting, in terms of how co-invests are distributed. So a couple of years ago, we were keen to kind of try to bake into a document that says, hey, we have certain rights, the GP, you guys have to show us, if you're showing other people, you have to show us, the co-invest, there's always been a lot of pushback on that. And we've always thought about it in terms of size of commitment is related to kind of the amount of co-invest you're going to see. And what we heard from a large team recently was, hey, we don't care what your size is. What we care about in terms of offering co-invest is how quickly you can respond. Because one thing I would like to say is, we all as LPs, I think, say, hey, we want co-invest, we want co-invest. It's easy to say that. The GPs say, every time they say, everyone wants it, but when it comes down to it, it's difficult to get it approved, and to get it approved quickly enough, to participate. So, and then that translates into, how quickly you can respond. And so this GP actually went as far as to say, look, if you can respond in 2 weeks, you're going to get a huge amount of co-invest. I mean, multiples of what you commit to the fund. If it's 4 weeks, it's not going to be as much. If it's 6 weeks, you're going to get some, but not a ton. And I thought that was just very realistic, given the timing dynamics that GPs are dealing with in terms of putting a deal together.
Great. Vatsala.
So on the fees, right? So technically, I mean, co-investments is not free, because transaction costs are still paid by the co-investors. And if there's any breakup cost and all, is actually paid by the fund. So if the LPs in the fund who don't co-invest, they're actually subsidizing LPs who does co-invest, right? So I guess technically it's not free. But so in terms of what I've been seeing is in the past, there were a lot of like syndicated deals done on ad hoc basis. It was previously offered to favorite group of LPs who are close to GPs. So nowadays, there's more transparency and clear process, because LPs really push for it in terms of the side letters. We demand a lot of things from the GPs. So what really happening now is it's being open to more wider group of LPs. That's what I'm seeing.
Thank you. Timo.
Yeah, perhaps on Chris's point on sort of deliverability and timing, it's been always very important for us. So we basically have been saying to our contacts that we can mirror any decision that you will take within your process within 1 week. And that has been kind of a route to getting basically that preferential access to any co-investments offered. And then once you deliver it once, it's easier to get the second and third with the same manager, and kind of going to that direction that it's not a function of your commitment in the fund, but it's rather being there when you're needed. And that also serves us well, coming back to the point of working with emerging managers. They tend to have too small funds, lack of capital. So being there to help to bring a very good deal across the line is a mutual win-win situation. So that to say that in most cases we don't pay any fees on the investments, but equally if we are working with the group who works maybe more on a deal by deal basis, syndicates the broader audience, or is a new contact to us, and we don't necessarily have a fund commitment angle there, we are happy to pay some level of fees and in particular carry to compensate for the work done. But otherwise we are happy to take it for free and let those investors, to Vatsala's point, pay who are not taking the co-investments.
Absolutely. So thank you for everyone's perspective on this. As a matter of fact, in part we touched on the next question, which is what value do LPs bring to the table, and how are GPs managing the increase in demand for co-investments? Now, since we have a little bit of time, I would actually like to take on this question. Apolis is a single family office. We are very much focused on co-investments. And for us, getting in the door, getting a chance to participate in co-investments is certainly about value add, but it's also about just being a comfortable partner to a GP. And as I think it was Chris Brown who mentioned, speed is very important. If one can move fast and never become a bottleneck in the process, then GPs will definitely take a note of that. Anyhow, on to Greg Schuler.
Yeah, I mean, I would agree with everything that you just said. Depending on the institution that you're in, you can have
just one technical point. We could keep this answer to like 20-30 seconds. We need to move to the workshops.
Okay, sorry, Mark, did not realize that.
Yeah, right, no problem. So I mean, at Pitt in particular, we got general partners introduced into our research. If you're at a hospital system like Fred, where I was when I was at BJC, you can also get them introduced into medical research. And so I think depending on the institution you're at, you can be more than just a source of capital to a GP. You can be access to research.
Great. Fred?
I agree with that. We, as a healthcare investor, we also periodically make what we call strategic investments, invest in companies that we do business with on the operating side. Yeah, I would agree with everything. I don't have anything to add.
Yeah. Chris Brown, would you like to add anything?
I'd follow up. I think, Timo, you said it before. We a lot of times, and maybe Vatsala as well, use co-invest as a way to get to know a manager, particularly as, well, one, to get to know them, whether they're established or not. Two, to if it's an emerging manager, if it's a new manager, to help them with one of their first deals, and obviously that brings a lot of value.
Yeah. Thanks, Vatsala.
And as a family office, I think they can use their permanent capital status to better align their investment strategies by investing in directly in founders, driven opportunities. So because those entrepreneurial family have expertise and connections, so they can make more than just a capital contribution. So I think that is really the key value that family office brings to the table.
Great.
In a deal. Yeah.
Timo, you have the last word.
So then just perhaps to add that we see probably around 100 deals underwritten every year, monitor a portfolio of a few hundred companies. So we see much more than any of the GPs. We have more mistakes done in our underlying portfolios, more lessons learned. So being a sounding board and perhaps bringing this sort of experience and knowledge onto the table when looking at something that adds something in particular for the newer emerging managers whom we typically work with.
Great. Thank you. So we're now going to transition to the workshops where some of the managers we met on the opening panel will share their war stories and we'll take a deeper look at their individual deals. Thank you very much.
A quick comment.
What does LLM stand for?
Let me just clarify that for you, Rob. So there are 4 breakouts. If you look at the front cover, you'll see Star Mountain is the lower middle market private lender. RealFi going up is the real estate loans. Chicago Atlantic is number 2, and BFY, Better For You, is the lender to health and wellness brands.